This is the fastest growing trend in the advice industry, and today we're going to understand why. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. My name's Bryce with my co-host Ren, and today we're speaking to one of Australia's leading asset consultants about the rise of SMAs and how she helps advice firms build portfolios. Ren, good to be with you.
Bryce, good to be with you. Today we're going to be joined by Angela Ashton. She's the founder and CEO of Evergreen Consultants. They're an investment consultant or an asset consultant for a number of advice firms and smaller institutions. They also have a fund ratings arm and do some work on responsible investing ratings as well. So a lot for us to unpack today.
Big time. She has extensive experience in the industry. That's how we're going to start today's episode to get a sense of how the industry has really changed over the last decade or so. We're going to dig into how Evergreen think about building portfolios and strategic asset allocation, and then close out with some important tips and tricks on how to actually get SMAs right when thinking about using them for your clients.
Yeah, it is, as you said in the intro, it is such a fast-growing part of the market. When we were speaking to advisors and preparing to do this show, Basis Points, over and over again, SMAs were coming up, but also just the rise of asset consultants and wanting to hear from different asset consultants about how they approach building portfolios. Because the stats are pretty amazing. We were reading them before. So now more than half of advice firms use SMA structures. The growth of the number of advisors using SMAs is up 50% since 2019, according to advisor ratings. And the obvious reason why advice firms are moving to the SMA model is scalability and advisor time. And I think we saw some estimate that they reckon 16 hours a week is saved. Now it's not universal, we should say. We spoke to Andrew Hewison, who does not like the SMA model, prefers individually managed accounts. So it's certainly not an overwhelming consensus. But it is a big trend that we wanted to better understand.
Absolutely. Now, we want to say a massive thank you to our launch partners for Basis Points, Orbis, Milford, and SIBO for the ongoing support here. Without them, we couldn't keep all of this content free and accessible. So a huge thank you goes to our three launch partners.
And finally, we should say, if you're an advisor watching or listening to this and you want to claim the CPD points for this episode, all of our episodes are accredited by the FAAA. So if you want to claim the CPD points, go to the link in the podcast show notes or the YouTube description. There'll be a link there. You can complete the quiz, get your certificate. But look, Bryce, with that said, let's get to our conversation with Angela.
Angela, welcome to Basis Points.
Thank you. Thank you for having me.
So let's set the scene. For those who are unfamiliar, how do investment consultants work with financial advice firms?
I would say that they work in a really wide variety of ways. So there's not one sort of method that happens by. So you can have an investment consultant who just gives a group some advice, maybe sits on an investment committee, or maybe even just is available for some phone calls, to offering a whole suite of services where they're building investment portfolios with them or for them.
Yeah, right.
So it can go from small to very large.
Yeah, right.
Yeah.
So that's obviously what we want to unpack in today's conversation. But sure. I think before then, we want to hear a little bit about your journey with Evergreen. So if you take us back to 2016, I think if you think about asset consultants and investment consultants, they're probably more associated with large financial institutions. So take us back to 2016. What was it like starting a consultancy focused on smaller institutions and advice firms?
Interesting. And I was probably very silly. Look, I've spent a lot of my career, if not all of my career, doing stuff like this, i.e. doing research or investment research, primarily for financial advisors. I spent some time in a couple of institutions, but primarily for financial advisors in some way. And there was a period in this part of our industry where investment research wasn't really valued by financial advisors or their dealer groups, particularly when there was, like a lot of really large dealer groups. And that was quite disheartening for me because I really believed in its value. So I actually spent about 10 years not working in this part of the industry. And I worked for other people doing other things. And then around that time, 2016, we saw a few things happen. A group called Van Eyck exploded. and that was one of the big research houses in Australia, so they sort of fell apart. But we also started to see the big dealer groups start to sort of come apart a bit. And there was all of these smaller independent financial advisors that all of a sudden decided that they needed research and they had to pay for it somehow. And they wanted something a little bit more tailored. So I sort of saw a couple of people I knew set up businesses, and they were, having some success in selling services like this to those sorts of groups. So I thought to myself, with the help of someone else who has left now, but my co-founder at the time, if we're going to do it, this is it. This is the only chance we're going to get. So all of a sudden people started to value it again. So we started doing that. So it was a little bit scary, a little bit interesting. It was, the cowboy days, really. Yeah.
Why did they start to value it again? What was the catalyst, I guess?
That's a really good question, and I'm not sure I know 100%. I think part of it is that they went from really big dealer groups where there were hundreds of advisors, and they were given, some pretty average research and told this is what you must do, to coming out, being independent and going, I actually don't know what I'm going to do, and now I have a chance to do something, that's a bit more tailored.
Yeah.
So I think that's what happened. And I think, the loss of a group that was probably the preeminent group in doing that in Australia, that really, good quality, tailored research, sort of meant that it was open for others to try and have a go.
Yeah, right.
Yeah.
And you said it was the cowboy days. Give us a sense of the past decade, because, you sort of caught that wave at the time where research was being valued again, but you've been in business through the Royal Commission and through all the changes, and, the number of advisors has probably halved in the time that you've been in business. So give us a sense of how Evergreen's grown, and I guess how you've navigated the last 10 years.
Yeah, it's been a really interesting journey. It was the cowboy days. I remember, again, like in the first couple of years, like definitely that first year, my co-founder and I didn't know what a managed account was, and that's now a lot of what consultants do, and I think we'll talk about that a bit later, but that was brand new, and me and my co-founder sat down after about 6 months of being in business and went, how does this thing work? And so we sat there for like a couple of hours going, going through papers and all this sort of stuff and sort of working it out, and then we both went, this is how things are going to evolve, and we sort of had finally the light bulb went off, but I don't know that a lot of people had gotten that yet. And then there was back then in, let's call it like 2018, there was some conferences for managed accounts, and we'd go there and they'd have these panels, and I was on some of the panels and stuff, and everybody, like, the questions were, so what is a managed account and what is this? And the audience would be filled of people who had no idea what was going on. It was and I remember saying to my co-founder, this will be like, we'll look back at this and go, do you remember those days? And it really was like that. Like, it really is like that now. You go to a managed account conference and everybody knows what's going on. It's really slick, and there's 100 competitors rather than the 3 there was back then. It's been incredible. Sometimes, like, the growth rates that you can have, which I guess you guys must have too, right? In terms of how fast the business can grow. You just sit back and go, oh my goodness. Like when you watch it grow sometimes, it's just incredible.
Well, I think that's a good segue. You mentioned there that over sort of the past decade, we've gone from sort of 3 competitors to hundreds in the space, and you've become very influential in the advice space. But there's, I guess, a lack of standardized ways of measuring you against each other, a lack of hurdles to set up a consultancy as well. So how do you think advice businesses should measure consultants? Like, what metrics should they be using?
I'm not sure if metrics is the right thing to do.
Okay.
But what I would say is, what I've noticed is a lot of advice businesses don't make the decisions around consultants in a very considered way. Maybe that's a bit negative, but like, how do I put that positively? Probably don't think about all the things that they should or could think about in terms of building, sort of choosing a consultant. So in terms of some of the clients that we've won, we've gone through RFPs that are 50 pages long.
Wow.
And then others where you might get a half hour on a Zoom call and then they ring you a week later. There's no right or wrong. And so it depends a little bit on what they're looking for. So they have to think really about what it is that's really important to them as a consultant, because I've definitely seen advice firms change consultants very quickly. And sometimes a couple of times, and it's because they haven't really fully thought about what it is they need from that consultant. So, do you need, and whether it's something like, do you need them to have a similar investment philosophy to you? Do you need them to work in a certain way? Do you need them to be able to look at certain types of funds for you? Do you want the ability for, to ring up and go, I want you to look at this fund for me, and they'll do it? Or do you want them to basically hand them everything? So, there's all sorts of different ways that this relationship can work, and advisors probably need to spend a little bit of time thinking about ideally what the things for them are that they must have, and then think about the things that would be nice to have, and then they can think about the sorts of groups that might meet that standard. So for me, the things that are non-negotiable, you don't actually need a licence to sit on an investment committee, so you don't need to be licensed at all. I would say that, to me, you want your consultant to be licensed.
That's crazy.
I know.
Wow.
So there's, there's just some basic things like that. For some people, the background of the people in there will be important. So, if you look at, say, a group like Evergreen, we come a lot from, not directly from advice, but we've worked with advice firms. I've done that sort of for most of my career, right? As well as a couple of institutions. Others are basically ETF salesmen that have set up, right? So if that's what you want, that's great, okay? But you got to know what it is you're really looking for in terms of the consultant's background and how they're going to treat you. And if it's really just some ETF model portfolios, go for it. But if it's something a little bit different, then, think about that. So, I think there's different things. And when you get to very tailored advice like that, metrics aren't very good, because metrics really only, when you think about metrics in our world, it's really just measuring the performance of an off-the-shelf model. That's the only thing that you can do, right? And that's absolutely valid. And you don't want somebody that's, the bottom quartile all the time for that. But it's not necessarily what you need. So you need to think about, is that actually going to give you a guide to, is it right for you? So, I would suggest, if you're looking for a consultant, that you really sit down and spend some time thinking about the things that are important and what you want the relationship to look like. And then you can you can better find the right group for you. And spend some time.
Yeah.
Yeah.
More than half an hour on a Zoom call.
More than half an hour on a Zoom call. Yeah.
So I like that there's no right way to do it, and you need to think about your goals and your needs, much like investment decisions
good words
themselves.
that I didn't use.
Yeah. But I guess on the flip side, are there any red flags that advisors or advice groups should be watching out for? Like anything, similar to the not being licensed, where you're like, you should double take if you say that.
To me, I think there are some consultants that don't listen to the client. Sometimes I've come across advisors that feel like they're backed into a corner a bit. So, in the end, they're your clients. You own that.
Yeah.
So you need to feel empowered rather than bullied, right? So I think, that sort of thing. Look, I could tell you a couple of horror stories, but, I think you need to just spend some time thinking about, sort of delving a little bit into the reputation of some of the consultants, in terms of what they've done in the industry in the past.
Yeah.
So you mentioned there one of the things that you should consider is alignment on investment philosophy.
Yep.
And we want to now turn to Evergreen's views on building portfolios. So at a high level, what are your bedrock rules of portfolio construction?
Yeah. So I think there is one big bedrock rule, and that is that the strategic asset allocation has to be right. So we spend a bit of time making sure that happens. So, if you've got a portfolio or for a risk profile, for example, say a balanced portfolio, we have definitely come across potential clients where we've tested the asset allocation that they're using and it won't hit the objective. And that's not that hard to do. We've built some tools to do that, and we're actually doing some work about making that a bit more commercial. But you need to just check for those basic things. So if you can get the SAA right, then you obviously lift the probability of everything being okay for your clients in the long run. So that's the most basic thing. And I think some of the other bedrocks, I guess, would be minimise turnover, because turnover will just kill you. People turn over too much as a general rule. They tend to leave managers too quickly. And the buy-sell spreads, as well as any tax consequences, can often just destroy a lot of the value that you can add. So, it would be to minimise turnover, move away from your strategic asset allocation when you know that when you've got quite a good probability of that being the right decision, i.e. most people can't time markets, right? Don't try. If you see dislocations, absolutely, but there's no point moving a portfolio every week.
Yeah.
Yeah.
Let's start with asset allocation. And I guess high-level question, is every asset class on the table? And then how do you approach some of those new and emerging asset classes, private credit, crypto, the like?
Yeah. So when we work with clients, it's generally on a platform. And it's generally managed accounts. It's not necessarily always, but when you work with managed accounts, it has to be a daily liquid product. So you can't use private credit, and you can't use anything like crypto because they're not available on platforms except through an ETF.
An ETF, yeah.
So theoretically, you could use an ETF to get some crypto. Very few people do it, and I would say that if your clients want it, it's probably not something you'd put in a portfolio for everyone.
Yeah.
It's not off the table. Yeah. But it's not what you'd give everyone.
It's not off the table, but it's not off the shelf.
Yes, correct. Exactly right. Yeah. So, but stuff like gold is. Yeah. Private credit, not so much, because it doesn't work in that sort of managed account world. But outside, sure. Yeah.
Another thing you said there around the bedrock rules of portfolio construction was minimising turnover. And so when it comes to like the timing of managers and assessing managers, and then if they're underperforming, changing managers, how do you think about that frequency?
It's one of the hardest things in what we do. So a lot of research, like long-term research out of universities in the US and all that sort of stuff, do point to the fact that most people, including institutional investors, move too soon. And they don't see out periods of underperformance for long enough. So they jump too soon and often the manager rebounds, more than likely. And they often move to a manager that's done well and then tends to do poorly. Now, I know everybody sort of might make a joke of that, but there's enough research that shows that people do that. The reality is I probably then tend to think about that and go, we really need to think a little bit more long term. And sometimes that's probably not been the right thing to do for, in certain cases for us. Sometimes it's been exactly the right thing to do. But there's a balance there, and I think it's quite nuanced as well. It depends on each time. Each time is different. There's no rule here, right? So you've got to work out why they're underperforming. If it's just around style, we've had a really interesting period in markets where, and say for that decade from the GFC to COVID, even call it, right? So more than a decade, nearly 15 years, where we had QE and all of that sort of stuff. So volatility was zero, interest rates were zero, and growth assets went for an absolute tear. And the growth style just went crazy, right? And so the right decision through all of that period was to be in the growth style for equity assets. And value just underperformed consistently. I mean, there was a few periods where it did okay, but as a rule, it did quite poorly. I would think there's lots of people out there that would go, I've looked at the last 10 years of performance and value doesn't work, so I'm not going to invest in value. And 10 years is a good period, right? But it's not indicative of how value or any of those sort of factors perform over the long term. And right now, at the moment, with all the volatility in markets, value's doing quite well. So I guess what I'm saying is, if you were to sell a value manager because it hasn't performed over the past 10 years, or not even consider value, you're actually probably making the wrong decision right now. And a lot of people don't sort of go, oh, what did it do in the 90s? That's actually relevant to now. But the reality is it is. So you've got to have a longer term time set. You've got to really, I think, spend some time on the research around this sort of stuff. The value factor does have value. So I think a lot of people have written it off, and I suspect over the coming periods that might be to their detriment.
Yeah.
Well, at Evergreen, you have an in-house ratings arm to help select managers.
Yeah. It's not actually for managers in managed accounts. It's actually for things like private credit.
Okay.
So it's for non-daily liquid stuff that we can't use with our clients.
What are the criteria that you use to I guess, come up with that rating system?
Yeah, so that rating system looks at, as I said, private credit and stuff like private equity, VC type funds. So stuff that sits outside that managed account daily liquid type exposure that is standard for a lot of financial planners.
Why do you separate it?
Because we can't use those sorts of products in Evergreen Consultants. Because in a managed account, you can't use them.
Yeah.
And they also need a specialist skill set. We've got a team of people who work on Evergreen ratings that have specialist skills in there. One guy's a hedge fund expert, one's a property guy, and then there's a couple of guys that can do a little bit more broader stuff. So some private credit, some VC, that sort of thing. We also look at things like agriculture. We've looked at things like water funds. We've looked at all sorts of stuff like that, right? So there's all sorts of things about those sorts of funds that make them difficult to do while you're also doing sort of a lot of standard daily liquid funds. So you need to spend more time on things like governance. Does it have an external trustee? Does it have an external custodian? Just those two questions. If there is a yes to at least one of those two, you will miss 95% of fraud.
Really?
At
Okay.
least. Because there's an external group actually looking at what's going on.
Wow.
So Madoff got away with it because there was no external group. There was no external trustee. There was no external custodian. Wow. So, those sorts of things aren't that hard, but you just got to spend some time doing it. And those guys in particular spend more time on governance, people's backgrounds, past experience, and in things like private credit, looking at how they assess loans and stuff like that. So there's more detailed work. You want to be more careful on that stuff.
Wow.
On the private credit conversation, it seems like we're seeing a slowly rising trend of private credit managers having to step in and, I guess, become equity essentially and start running these businesses. I mean, the Rockpool example is probably one of the more notable ones.
Yeah.
How are you guys seeing these private credit funds at your ratings arm, and how are you
We
sort of
haven't
thinking
had
about
an
them?
issue yet.
Okay.
So none of the funds that we've rated have had a problem as yet. There's probably a little bit of luck in that. But having said that, there's also some, the guys spend a lot of time on it, thinking about how loans are assessed and the quality of borrowers.
So not worried about the asset class, just looking for quality within the asset class.
Yeah, exactly.
Yeah.
There's lots of private credit funds that are fine.
Yeah. One other, I guess, arm of your business that we found really interesting was you have a responsible investing grading index.
Yeah.
And, Bryce and I aren't that old, or we like to think we're not that old, but it feels like we've lived through a full life cycle of ESG.
I've lived through 3.
Okay, yeah, 3. It's very specific. Yeah.
I'm that old.
It was funny. It was 2021. It was every second question we got here at Equity Mates was about ESG and the ESG funds, and they were getting a lot of fund flows. And then
I think Vanguard ruined it for us all.
Do you think you blame them?
Well, at least partly. Yeah. I
Okay.
mean, that whole greenwashing thing.
True.
It's made it a lot harder.
Yeah. I also think the fact that oil prices spiked and all the coal
Yes.
companies had
Everyone
a year
did
of
well.
super profits. and
Lots of
everyone was-
things all at once. Yeah.
So how you, when you speak to planning firms, what's their sort of level of engagement with responsible investing in ESG at the moment?
Look, there's some, but it's not a lot. So we went through a period where every new client we got wanted ESG portfolios as well. That stopped. We do see some interest. So we've just gotten a new client recently, and they don't want an ESG model, but one of the advisors in there does some ESG work, and so we'll probably just build them a paper model. and we'll work with them to put it onto our index, onto our website, and we'll keep them updated and manage it that way. It won't be big enough to do on its own. There's some, but it's not huge. Yeah. People are worried about greenwashing. We get some interest. Some of our clients have charity clients, so we have to do some work on those for them. Like, just make sure everything's okay.
Yeah.
So it's nothing like it was 3 years ago. Nothing.
Do you think it will get back to where it was?
Not for a while.
Not for a while.
No.
Yeah.
No, not for probably a long while. The place where ESG is still huge and probably more important than ratings or anything else is New Zealand. So New Zealand is so green, it's ridiculous. So every fund has, needs some sort of ESG filters. So they're still having those conversations that we had 3 years ago.
Wow. Is that because New Zealand clients are different, or is that just the nature of the fact that they're all hydroelectric and they're actually having success on some of these things?
Oh, it's probably all of that.
Yeah.
It's just a really different mindset around, climate and all the rest of it. Yeah.
How do you think we can avoid greenwashing?
Oh, well, that's actually really easy. So in that, every example of greenwashing that we've had, and the definition of greenwashing is effectively not doing something you say you do, right? So the reality is, if managers were really clear about what they do and they checked all of the claims they made, we wouldn't have greenwashing issues.
Yeah. Yeah.
So Vanguard didn't filter in the way they said they did.
Yeah. Now, Angela, we want to talk about getting SMAs right. Is there a particular size in terms of assets under management where a financial planning business needs to get to before actually profitably running a managed account model?
The word profitably is interesting.
Okay.
So we might come back to that in a sec.
Maybe. Yeah.
So in terms of how big an advice group needs to be, that's often dictated by the platform. The platforms usually want about 100 million in total over some period of time, and that might be 2 years. So the rule of thumb is that maybe 60% of the total funds under advice that an advice firm has could potentially go into a managed account. So that would indicate that you need maybe 200 million.
Wow.
To successfully run a managed account. In terms of profitability, financial advisors can't really profit from a managed account. That would be conflicted remuneration.
Right.
So there are very few, if any, platforms that I am aware of that will allow a financial advice firm to charge a fee on a managed account. Some will allow cost recovery, but other advisors, sort of build it into their own advice fee.
So it's the advice fee.
Yeah.
So you mentioned back in 2016 when you started, people were asking, what is a managed account?
Yeah.
And less than a decade later, it's becoming more and more sort of industry standard. As you consult with firms that are making that transition to managed accounts, how have you seen firms get it wrong, and what is sort of best practice as they make that transition?
Because of the sort of level of funds under administration that they need, you often need to have more than one or even two advisors sort of supporting the managed account. So often what happens is not everybody's fully on board. So they all have to buy in. They all have to support the transition to a managed account and the managed account itself. So you need to have a group that's clear and together on what they want to do with respect to this. So you often see them fall apart where one advisor supports it and others don't. And they just can't get to any scale that makes sense. The second big thing that you see is that advisors don't actively support it. So they may agree with all the decisions, but they don't actually actively move their clients across. And that could be because they don't feel comfortable or whatever it is. So you can have a situation where you're having great investment committee meetings, everybody's on board, everybody's having great debate, you're feeling very, close and all, aligned, but it's not being supported. And that doesn't work for anyone. So, because it doesn't help the advisory firm, it certainly doesn't help us. So you have to have buy-in, and you have to have process. And you probably have to have the right number of managed accounts. If you have too many, you'll find that some just don't get
Well, that flows into
supported.
the next question we had. What is the right number?
Depends on the group, but I would say as a general rule, it's 2 for smaller firms, a balanced and a growth. Okay. Then it can grow a bit bigger as the firm gets bigger. It might be 3, or they might have some RI models as well. So I think that's generally how it looks. Our clients range from 2 to 11.
Oh, wow.
But the 11 is on 3 platforms. So they've got some index ones on one platform. They've sort of structured it slightly differently, but they're actually the same underlying portfolios. They're just sort of structured slightly differently.
Right. Okay.
And then they've got like more active ones as well.
And so you mentioned earlier that you sort of rule of thumb 60% of a firm's assets under management could go on a managed account.
Yeah.
Do you sort of think about that 60% is the right rule of thumb at a like client level, like, you know, that's sort of their core in a model portfolio, and then there might be 40% invested around that in other assets?
Yeah, it often depends on the size of the client. You know, the funds that they have. So if it's a smaller client, a younger person comes in, it's quite likely that they can be 100% in there because they don't have any other assets. But as you know, if somebody older comes in, they'll have they'll have some shares, some CBA shares from the float or whatever. And so, you know, those things need to stay outside. They might also, you know, a managed account also can't manage, obviously, anything like private credit or any sort of like a property syndicate or something. So depending on, you know, the advisor business, the client complexity, they can have all of those things outside. So, you know, 40 might be the average, but it's probably more like, so we've got one client, for example, and his book is all wholesale. They're all quite sophisticated. So he's got quite a lot of stuff like infrastructure, private equity, and so on. So, and we have 20% of his funds under advice. But I would say, as a general rule, most of his clients would have, say, 20 to 30% in our models, and then the rest would sit outside.
You mentioned one of the bedrock rules of portfolio construction was minimizing turnover. So how do you advise the firms that you work with to manage that review and sort of rebalance process?
We meet with clients regularly. The frequency of investment committees depends a little bit on the client. Some want it monthly, some quarterly, some in between. But we always leave the option open that if something happens in markets that we can ring and have an investment committee quickly. Yeah. So you've got to try and, you know, manage that communication. But in terms of just making sure that turnover is lowered, you've got to make sure that the portfolio is set up right initially, right? So you've got to invest with managers, whether it's passive, active, a mixture, whatever it is, a group of managers that you do really believe can add value and have generally been consistent and, you know, true to their word and all the rest of it. So you've got to start with a group of managers that you have faith in and work with that as an initial starting point so that you don't have to turn over a lot. It's also, you need to also think about, well, it depends a little bit on market conditions at the time you do set up. But you need to think about that idea of the portfolio as much as possible being all weather. So, you know, that you're not trying to second guess markets constantly and turning over as a result, because you're highly likely to get it wrong and cause all sorts of other damage. So it's about, you know, initially at least having a portfolio that should see you through even if you don't do anything else to it.
My ears picked up when you said the clients, depending on their preference, can have monthly investment committee or up to quarterly, but if something goes on in markets, you know, they can call an emergency investment committee. Take me back to late January 2025. How many emergency investment committee meetings did you get around the DeepSeek stuff? Were people panicking? No.
Okay. But we did a lot in COVID.
Yeah,
right? So we were having investment committees twice a week at the worst of it.
Wow, okay.
With clients. And what we would have, like the team would have a early first thing in the morning, so 8:30 or 9 or whatever, and each day we would allocate a couple of clients per staff member to just ring and just say, is everything okay? And we do, you know, a webinar a week and a piece of communication every week. as well as reaching out. Between us, we were reaching out to clients probably twice a week, as well as then potentially, if things were going on, having an investment committee meeting as well.
It's an interesting moment there because clients look to you for confidence and in some ways to have the answers, or at least, be able to directionally guide them.
Yep.
But I imagine in that moment you probably felt like you didn't have a lot of answers like everyone else.
Oh, okay. So COVID was so much like the GFC.
Oh, that's interesting. Okay,
So COVID, in terms of the way that markets moved and the Fed stepping in and all of that sort of stuff, was like the GFC, except on 10 times. So I was lucky in that I spent the GFC at QIC in the asset allocation team. So that was probably the best grounding for COVID that you could possibly have. I think the current times are actually much more difficult. And we actually had a client yesterday say, this is going to be a bit like COVID, and I actually had to say it's going to be nothing like COVID. The thing that we are now facing is completely different. The Fed's not going to step in. The things that happened aren't going to happen again. But COVID, for anyone who'd lived through the GFC, luckily was actually, it was bad, but it wasn't. The way that markets behaved was actually quite similar. So I think you've just, but the other thing is you got to just keep a level head, right?
Yeah.
And just, and give people as much guidance as you can.
It's crazy that you're going to make us nostalgic for the COVID markets of all things. So I guess, you can say that the COVID, you could sort of pattern match back to the GFC, and you could sort of see that there was a playbook that authorities would take, and you could sort of set your expectations that way. If this moment is harder, what are you sort of comparing it to, or what are you using to base your analysis on?
I'm not sure, given what's happening, in terms of, I think a lot of the institutions that were set up straight after World War II effectively being dismantled, and the relationships that have been in place for all of that time, sort of falling by the wayside. I'm not sure that we've got a good playbook here. So I'm not, but I think, the way markets are behaving right now, I think what they're saying is they're not quite sure exactly what to do next. So, because we just don't know.
Yeah. Well, Angela, to close out, there's no doubt there's been a lot of change and evolution in the industry and in terms of product over the last sort of 10 years.
Yeah.
If you were to try and make a prediction on where we'll be in the next 10, where do you think that'll be?
We'll be the 53rd state of the US.
Nice.
Or the 54th, I don't know. Who knows?
Well, Angela, we look forward to getting you back on in 10 years. We'll have a bit more of an American twang to our accent.
Yeah.
But I'm sure SMAs will be even bigger than they are today.
I think so too.
Yeah. But thank you for joining us today on Basis
No,
Points.
thank you.